Hey, what's going on, everybody? It is Wednesday, June 29th. We got one more day left in the month, one more day left in the quarter. Kind of a quiet day. Dow finished up marginally, small losses in the S&P and the NASDAQ. Just a quiet day. On the fiscal front, yesterday actually was a positive flow liquidity day. Small, about 6 billion. That was the first positive liquidity flow we've had in a while. So that puts the deficit for June up to 43 billion. That's small, and I'll just say that's too small to, I think that's too small to avert a recession, which it looks pretty certain that we will have a negative GDP for the second quarter. If you're a trader, and I mentioned this yesterday, if you're looking for short-term trading, Friday is July 1st. That is the first of the month. That's the big government payment days where you get, Medicare, Medicaid, military pay, veterans benefits, disability, all that stuff. And it's also this Friday, we will get a Social Security payment. So that's going to be like 100 billion flow day. That should be positive for the markets. If not Friday, then Monday. So if you are a trader and looking for a short-term trade, I would position, maybe today was even the start of it with this kind of flat market, but I would position long Friday into early next week, Monday, Tuesday, based on that very large flow. The month, I have to say that the leading flows this month for June, they're not that bad. Through yesterday, June 28th, 531 billion so far for June, the leading flow. The problem is the government is just, it's taxing it all, practically taxing all of it back immediately. But 500, we're going to end up with June probably around 560 billion. That's a good flow. That is a very good flow. And if you average out since the beginning of the year, we're running close to 600 billion, just slightly below, probably slightly below 600 billion. I got to take a look at the average out all the months, but that's what it would appear to be. The problem is that, like I've been telling you guys, that taxes are growing faster than the spending flows, and that is just leading to this fiscal drain, this liquidity drain. Let me talk a little bit about oil, because today we got the EIA release, the weekly release of the petroleum status report. Last week it was delayed because they had some kind of system issues over there at the EIA. So there was a draw in crude. I think the draw in crude was like 2.5 million barrels, something like that. Both gasoline and distillate saw a build. Right now, crude is down about 8% year over year, the inventories. That's not bad. That is the smallest year over year negative differential in 14 months. All right, so that year over year gap is narrowing. Gasoline inventories now are the highest in 2 months, and distillate inventories are the highest in 3 months. Gasoline demand is pretty steady. It was about, I think it was like 8.9, just below 9 million barrels a day. It bounced up sharply, I would say, from the previous week. All right. But distillate demand, and we're talking about diesel fuel, that's weak. I think that, if I'm not mistaken, that's like the lowest distillate demand is like the lowest in 6 months. And that is, it could be a reflection of prices, although gasoline prices don't seem to be cutting much into gasoline demand, although gasoline demand is down about 2% year over year. Distillate demand, and again, that's diesel, that's down about 7.2% year over year. It's at a 6-month low. It could be prices, or it could be a reflection of just, weaker economic activity. Diesel, right? Trucks, commerce. So got to keep an eye on that. But that's sort of a negative indicator for the economy. Just on a side note, if you're looking for another negative indicator on the economy outside of all like the inflation talk and stuff like that, and I mentioned this yesterday, average daily unemployment benefits. Those are the benefits the government is paying out every day. Now, 2 days in a row, over 100 million. That, you got to go all the way back to like the first week in May to see a level that high. And in May, the trend was actually going down. Now the trend is picking up. I mean, we hit a low a few weeks ago, or maybe it was last month, I forget the exact date, but we hit a low of, I think, 77 million a day, and now it's just been slowly moving up. So I think this gives a little indication of what we might see next week in the job report next Friday. Now, as I mentioned yesterday, I don't know what the forecast is on that. I got to go check that out, but I would not be surprised to see a weaker number next Friday. It just looks like right now with the pickup we've seen a pickup in initial claims for weekly unemployment, and now we're seeing the pickup in the flows, these unemployment benefits flows. Back to oil again, I'll mention that U.S. oil production. Here's the thing, because there's everyone's saying, oh, Biden, he's like anti. And this is, I'm no fan of Biden, so don't mischaracterize me at all. I can't stand the guy, and I'm no fan of Biden. But everyone's saying, oh, like he's anti the energy industry, and his green agenda is not allowing oil production to go up. That's just false. We're at the highest level of production in 26 months. And it's been climbing, since he took office. I mean, it's been going up. It's a function. I think it's a function of maybe finding workers, a labor issue, and also it could be a financing issue. But now, as we start to see commercial and industrial loans pick up, some of that may be renewed financing for the energy sector. So, I mean, that's going up. The other thing is about, and he last week he brought in a lot of these oil companies, and he was castigating them. But I mean, gasoline production right now is about 9.8 million barrels a day. I mean, that historically is pretty much where it's been. You can go back 3, 4, 5, 6 years. I mean, that's 9.8 million, almost 10 million barrels a day. I mean, that's we're running at what is the normal rate of gasoline production. The problem is we're exporting it. We're sending it away. I mean, I've been saying this for so long, man. We are now, U.S. is a net exporter of petroleum products, 1.15 million barrels a day. I mean, it's a simple fix. I think I'm the only one who's been saying this. I've been saying this week in and week out. Like, we are net exporting our surplus. So, I mean, of course, inventories are going to be tight and prices are going to be high. And the foreigners are getting the benefit, and so are U.S. oil companies who are just reaping the profits from this. But I mean, he doesn't want to do anything. He could ban or put a moratorium on exports, at least temporarily. No, instead he's emptying out the Strategic Petroleum Reserve, which I saw the other day is now, the SPR is down to the lowest level since 1986. So our energy security and our energy independence, and by the way, this all got started under Trump. To be fair, I mean, the criticism goes around. I mean, Trump was the one like, yeah, we got to export and make money. Country's got to make money. Well, all right, but you were just talking about, how you made us energy independent, but if you're sending it all away, who does that independence go to? It goes to the foreigners who get the bounty. That belongs to us. We're the ones who took the risk with our environment and, the Alaskan wilderness and all this stuff and pipelines. We're the ones, the citizens of this country, who should reap the benefit of that, not send it away to the foreign sector. But Biden's not stopping that. He's emptying out the Strategic Petroleum Reserve. And that's just a temporary measure. I mean, look, you gotta. Anyway, I'm the only one who's been talking about this, like ban exports or at least put a moratorium, stop it temporarily. You could always go back to it. Anyway, if you look at the numbers actually from the EIA Petroleum Status Report, I don't know, like, I'm not saying it's bearish, but some things seem to be moderating in there. Like, crude inventories are only down 8% over last year, compared to last year. At one point, we were talking about inventories, they were down 22, 23, 24% year over year. So that's narrowed quite a bit. Gasoline inventories are on the rise. I mean, they're up to a 2-month high. Distillate inventories are up to a 3-month high. I don't see a big impact from gas prices to demand. I mean, demand is down 2%. I do see a big impact, like I said, with distillate, and that's diesel fuel. And again, that could be a combination of price and just, I think it's probably more slowing economic activity, slowing commerce. Because otherwise, if it was merely a function of price, we'd see like a year-over-year drop equivalent to what we see in gasoline, like maybe 2% down. But this is almost 7.5% down. So I think it's more a factor of economic activity. And like I mentioned, I'll point to rising weekly unemployment claim. The next shoe to drop, I think the next shoe to drop, because look, bottom line, like I've been telling you guys, is that the fiscal picture is just, it's not supportive. And the only way it's going to get supportive is the ugly way, like I said yesterday. And that ugly way is when you're going to get automatic stabilizers kicking in. Unemployment benefits, food stamps, all that bad stuff when people lose their income. And I think that's coming. So the next shoe to drop, I think, is going to be jobs. And we'll see that next week. We'll start to see that next week. But I think we're already seeing that in some of the leading data. Monthly fleeting fiscal flows are good. That's the sad part of it. But it's being taxed right back out. So, I mean, what are you going to say? Anyway, if you're going to trade this, like I mentioned at the outset, Friday is going to be a big day, at least from a flows standpoint. It'll be like 100 billion day. That should be good for the markets, although I will remind you, and I think I said this yesterday in my video, that June 1st, okay, the first of this month, we had a 95 billion day and we had a big down market. So, I mean, but I think it popped after that. So just be aware of that. You get a big flow day. Historically, the pattern is when you see those big, positive liquidity flows into the system from these first of the month, the big first of the month government spending burst, some of that money gets deployed into the markets, and that's a driving force for, stocks, bonds, whatever. So that is the update for today, folks. Kind of a crawl today, not a lot going on. And what do we got coming up? Well, we got July. There's going to be no big events in July. We do have a Fed meeting, and that will result in, right now the market is still predicting a 75 basis point hike in July. I'm not sure what date that meeting is. I got to check it out. But that's all priced in. That's all priced in. QT, I think I mentioned this yesterday, quantitative, tightening, not really happening right now. The last 4 weeks have seen an increase in the Fed's balance sheet, small increase in Treasury holdings, and an increase in MBS. So they're definitely taking their time on this tightening. Remember, that was supposed to happen back in May. Bank lending has been strong, although I think I told you that consumer loans in the most recent data that we have through June 15th, consumer loans had their smallest increase in 6 months. So that also, if you want to consider, the initial claims for unemployment insurance, the drop in demand for diesel fuel, the rise in unemployment benefits, and now the smallest increase in 6 months in consumer loans, that might be another indication of slowing economic activity. And by the way, if that's the case, then the bond market is poised for a big rally, because it'll start to call the bluff. It'll start to call the Fed's bluff on, ongoing rate hikes. All right, folks, that's it for today. Enjoy. See you tomorrow. Bye.